Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, October 30th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are many. Got a jam-packed show for you today. So number one, with the Q4 QRA Part 2, roil the Treasury market, and by extension, global sovereign debt markets. Number two, is the U.S. economy still resilient? Number three, will Europe narrow its wide growth differential with the U.S. and support the euro? And number four, will the U.K. budget roil the gilt market and by extension, global sovereign debt markets? Our answers are that the 30-year nominal Treasury bond yields and 10-year TIPS yield are both unchanged on the day, implies Secretary Yellen did exactly what she needed to do to finance Uncle Sam in a manner that promotes financial stability via suppressing volatility in the Treasury market, which is our chief mandate. Specifically, projections for Q1 call for the highest net bill issuance and lowest net coupon issuance since 1Q 2024, respectively. The U.S. economy is still resilient, as most recently evidenced by the buoyant Q3 GDP data and strong October Conference Board Consumer Confidence Report. We maintain high conviction in our 2+ year-old resilient U.S. economy theme and anticipate that the current risk-on market regime condition is likely to generally persist into at least Q2 of next year. Investors should buy any U.S. election-related dip until Kiss or Dr. Mo instruct them not to. The Eurozone economy is likely to narrow its growth differential with the U.S. over a medium-term time horizon, as most recently evidenced by this morning's Q3 GDP data, which accelerated and beat consensus expectations in the Eurozone, Germany, France, and Spain. A grid model for the Eurozone economy currently projects an uptrend in growth over the next 12 months, while a U.S. grid model is projecting a downtrend in growth over the next 12 months. 10-year nominal UK gilt yields are down 11 basis points today, breathing a sigh of relief amid the first budget by the Labour Party in 15 years. In short, the UK Fiscal Authority appears to have learned the lesson that Liz Truss's budget gaffe in September of 2022 forced it to learn via the hardest way possible via VAR shock in the gilt market. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our community. This one's regarding China's $1.4 trillion in stimulus. So this is hot off the press. It says China considers $1.4 trillion in extra debt over the next few years. This is obviously positive for liquidity, but how much does this move the needle? Trying to be Bayesian here, as I think some of this was already expected. The question goes on to provide a few details, which include China's looking to raise fresh debt via special treasury and local government bonds. The package includes 6 trillion yuan to address local government debt risk. China's to approve 4 trillion yuan worth of bonds for idle land and property purchases. And then finally, Beijing may announce a stronger fiscal package if Trump wins in the November 5th election, which probably won't be decided on November 5th. So a few things about this in terms of the question, how much does this move the needle? The reality is it's probably not going to move the needle much from the perspective of Chinese economic growth, right? If you look at the sort of the size and scope of the package, it's right around 8% of GDP spread out over 3 years. Now, that seems meaningful, but it's a lot less meaningful relative to some of the larger fiscal stimulus packages we've seen out of China, most notably the one we got in 2008, which was 13% of GDP and concentrated in a span of 2 years. So investors need to be aware that the fiscal impulse in China is activated, is getting incrementally positive, but it's not the kind of fiscal impulse we've seen in recent economic cycles in China. However, I will say that this is moving the needle and from the perspective of removing tail risk from the Chinese economy, which our models suggest is sliding into a balance sheet recession. With China's sort of I would say panicked fiscal and monetary response in the last couple of months, a signal is that the Beijing, the Politburo Standing Committee, wants to put a floor under the Chinese economy, a floor under the Chinese property market, and a floor under the Chinese equity market. And specifically, Pan Gongsheng, the PBOC governor, has called out on several occasions over the past 6 to 8 weeks their desire to have higher property prices and higher stock prices. So we're not of the view to fight that. It's been our view all along that the measures that have been announced from a monetary and fiscal perspective, and these measures are been leaked, they have yet to really truly be announced. In fact, they're expected to be announced next in a couple of Fridays. Friday, November 8th, after the U.S. election, because there's rumors that the package may be increased if Donald Trump wins the election to counter some of the trade friction headwinds that we're likely to see in a second Trump administration. So if you summarize all the fiscal monetary movement that they're implementing, it's suggestive that we may see the left tail risk chopped off the Chinese property market and the Chinese equity market. And it's our view that when you remove left tail risk from a market, the path of least resistance is higher over time because liquidity goes higher over time as the monetary base and money supply expands and populations grow. All those things are supportive for asset markets and economies to grow over time, especially when you remove the left tail risk associated with the balance sheet recession that we're seeing amongst Chinese local government agencies and obviously the Chinese consumer. What the package falls short on is what the Western world has been clamoring for, because that's how they want to get paid by China, which is support specific stimulus measures for the Chinese consumer. The package is the rumored package is light on those types of measures, but ultimately we do believe that we're going to continue to see incremental monetary and fiscal stimulus over the medium term in China, because they now have a explicit focus on getting the Chinese economy resuscitated and getting the Chinese stock market and property markets to bottom and ultimately start to climb higher. And so in our view, we don't want to be fighting that as investors. The general take, when we talk to our clients, our portable clients across the global buy side, and obviously our community chat here, and just reading the tea leaves on Twitter, et cetera, the general take is that the Western world, most investors are still very bearish on China. In our opinion, we want to take the other side of that trade in the context of the panicked responses that we're seeing from a monetary and fiscal policy perspective in China. Again, to be clear, they won't work. China will slide into a balance sheet recession at some point in the next few years if it isn't already tiptoeing into one. But again, their panic is what's going to delay that, and delaying that, in our view, is bullish, and certainly in the view of Chinese equities, which continue to be bullish from the perspective of our volatile adjusted momentum signal. So I want to say Chinese equities are up about 30% since our discretionary risk management overlay, aka Dr. Mo, pivoted Chinese 42 macro clients to the long side of that particular exposure. So we continue to maintain that until further notice. So we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, October 30th, 2024. Everyone have a wonderful day out there. Best of luck, and we'll catch you back here tomorrow. Cheers.